We are looking at Tax 2601. This is support material 5. The first thing we need to look at is a bit of a recap. If you look at study unit 4, you would have seen that the topic there was covering income for a business entity. When determining income, we need to make sure that the gross income definition is met in order to then include a particular amount that was received by the company or earned during the financial year as part of the income tax for that year. Remember, when looking at tax, you need to follow the structure. So the structure starts with income, and we always need to look at gross income. With gross income, if something doesn't particularly meet the gross income definition, then you obviously need to consider whether it's a special inclusion or exempt income. So that's something you need to look at as part of the income distinction that you need to make when looking at different questions. Right, do I include something, yes or no? And if I do include it, how much do I include? Is a portion exempt or is the full amount included? That's what you're looking at. Just remember the structure when looking at a resident. The resident is either going to be taxed in terms of their worldwide income because they're a resident. If they're a non-resident, well, non-resident meaning outside the country, so you'd only be taxed according to the South African source. The biggest distinction to make here is looking at the actual residency. So if I'm looking at a natural individual, I'm obviously going to apply the ordinary resident test and the physical presence test, depending on which is actually noted in the question. So for example, someone would be considered an ordinarily resident of the country if they believe that this country is their home and they return after all their wanderings. When looking at the physical presence test, then it goes basically based on your time that you actually spend in the country. If you exceed a certain period of time in terms of the physical presence test, you would then be considered a resident, even though you don't believe this country to be your home, and you're going to obviously return elsewhere after your wanderings. But the physical presence test is important just to determine whether you have to pay tax according to your worldwide basis, which is residence tax, or on a South African source, which would be a non-residence tax. When looking at juristic persons, it's a little bit different because the taxpayer would be a legal entity, and with the legal entity, you then need to consider these three topics. The first being the place of effective management, and this is what stuff that we looked at last week, where we spoke about where is the company actually being managed, where is the effective management situated, and that's generally the head office. So that's a good indication of location in terms of whether this particular company would be considered a resident or a non-resident according to the definition. Then you also look at operational management, so in other words, the day-to-day running of the business, how is that managed? And also in terms of the economic nexus, how big of a market or a business operation that you actually have in a particular company in terms of size. So is the economic housing based in this country in terms of generating the most revenue, the most profits, and that's something that is also considered as part of this whole motivation and to decide on whether something is a juristic person as a resident or not. So just remember, with a resident, you're going to have two classifications, either an individual or a company. In your particular course, Tax 2601, you're going to be focusing mainly on companies. So the juristic persons would be more important than the individuals. Individual tax is covered in a separate module. So if I'm looking at juristic, I need to remember those three things: effective management, operational management, and obviously economic nexus. There's just a note about the structure. Remember, when calculating taxable income is the last line on this formula, and we know that taxable income is then going to be used to determine the tax liability. So there are two different workings that you need to remember. The first working is obviously looking at generating this taxable income. The second working is going to be looking at calculating the taxable liability. Both are important. If I'm looking at the taxable income, then I need to follow the structure. I need to start with income, which is what we looked at last week. That was a recap for study unit 4. With tax for individuals, you're obviously going to be looking at March to Feb. If I'm looking at a company, it could be any 12-month period. It will always be in line with the company's chosen financial year when they had incorporated. So when looking at income, you just need to determine what is the actual income that I'm going to have to insert and include in the actual calculation. Then we're going to look at deductions and allowances. That would be things that would reduce the income that you would have in order to get the taxable income. Later on, we'll also cover the taxable capital gain, which will then also be seen as a form of inclusion that you would have to incorporate as part of your taxable income calculation. So that's very important to note. Taxable income is a separate working. It's done according to this format. And then you've also got to look at the tax liability calculation, which is separate. When we looked at different types of businesses, you have a flat rate of tax for a company, which is 28%. You could also fall into an SBC category. And if you fall into the SBC category, then there'll be a sliding scale. If you choose to be a micro business, again, you need to meet the requirements, and then there'll also be a sliding scale for that. And it's only looking at revenue, okay, if it's micro, if it's turnover tax. So those are different types of taxes that could apply to a particular business. It's very important that you establish what the business is first, and then you can follow the correct process. This is just from last week when we spoke about study unit 4. We said how important this slide was. I can't stress this enough. When you focus on theory questions, you need to be able to list all the requirements for the gross income definition. Those are the 5 bullets that you need to address when answering a theory question. You need to talk about the amounts. You need to talk about whether this amount was in cash or otherwise. Then you need to look at, well, is this received by or accrued to in favor of that person, okay, in terms of the business. Then you need to consider, well, is this during the year of assessment? Because if it isn't, it might be something prepaid, for example, and that would be something completely different. So you need to consider, is the gross income definition met? And if it has been met, then you need to apply the basics. You need to include the income, and then you need to go through the process in terms of the layout and the format in order to work out the taxable income. The last note there in terms of bullet number 5 is looking at the amounts, if they are capital in nature or not. Right, remember, something is determined capital or classified as capital if you're looking at that whole tree and fruit principle, which was covered in that FISA case, which we spoke about last week. Right, so remember, there are certain amounts that are deemed as being income, and there are certain amounts that are income. And then you have other amounts that are outside the scope, which are seen as capital in nature. If something is capital in nature, it'll never be part of gross income. It'll then form part of capital gains, which is a separate consideration on its own as part of the Income Tax Act. Just remember there's 2 different classifications. You also get exempt income, so an amount that can meet the gross income definition but is specifically removed or excluded from the actual taxable income calculation. And we spoke about dividends and interest last week. Right, there is an interest exemption, right, and local dividends from local companies are obviously exempt because it's taxable already as part of the not STC. Secondary tax on companies, it's a withholding tax on companies, okay, dividends tax basically. And then we've got a note there about special inclusions. Certain things can be specifically included, meaning it hasn't met the definition of gross income, but it's specifically included according to the law, okay, the rules. Right, the rules will obviously outline what amounts need to be included, what amounts need to be excluded, and any amount that meets the gross income definition needs to be included, obviously. So those are special inclusions, right? And those are the ones that you need to study. Which amounts are exempt, which amounts are specifically included, and then you also need to support that with different cases. So if you are able to remember specific cases relating to specific topics, you do need to know what the judgments are so that you can apply that in your theory questions. And that leads us to study unit 5. Study unit 5 is looking at that second line in terms of the taxable income calculation formats. Okay, we've dealt with income, which is study unit 4. Now we're looking at study unit 5, which is the trading deductions and trading stock. Right, notice we're looking at the deductions here. We're not looking at allowances. Allowances apply to assets, and that's covered in a separate chapter, okay, not in this one. So in this particular study unit, we're going to be focusing primarily on the general deduction formula, Now, very similar to general income or gross income, we looked at a general definition for gross income last week, and now this week we're going to focus on a general deduction formula, meaning how can we apply the rules in terms of what SARS will allow you to claim as a deduction and what they won't. And that's something that you need to consider in terms of its practical application. And it's always an important discussion when looking at questions relating to theory, because they often give you a case study and you have to then identify the different facts of the case to determine whether you can or cannot deduct a specific amount from your taxable income. The last two things just to note from this particular chapter relates to prohibited deductions, so things that you are not allowed to deduct even though they meet the general deduction formula. And other things to consider is trading stock. If I'm buying stock, if I've got opening stock or closing stock, how do I account for that in my accounting records? So just to get started, you've got a few questions here to think about, okay, just as part of the introduction. First question is, how do companies generate profits? Right, and we've seen this before. We know that companies need to either buy and sell products, make and sell products, or offer a service. If they're looking at a profit, the profit would be what they have left over after they've taken all the expenses into consideration. So remember, the general formula for profit is income minus expenses. If I'm looking at profit specifically, well, I'm going to have to take into consideration all the expenses that I've incurred in generating that profit. And that's something that we always need to be mindful of. So when looking at profits, in order to create profit, there needs to be certain expenses. So now when looking at tax, we're looking at, well, of those expenses that I do have, are any of those expenses deductible? Meaning, can I also deduct those expenses from my gross income in order to get a reduced taxable income line item? Because remember, taxable income is going to be used to work out your tax liability. So if I can make the taxable income smaller by making use of some of these deductions, it's going to lead to a lower tax liability if I'm paying over more to SARS. Right, so how do these items benefit the company? Well, if I'm looking at the benefits, there's two things. Obviously, I need to pay for certain things: rent, water, electricity, stationery, etc. Right, and all of those items go towards running the business. Those items would obviously benefit the business through operations, but they can also benefit the business through a deduction. Other things to consider: what system do companies need to follow? Well, we're looking at a system. This is obviously looking at legislation, so rules and laws of the country. Right, we know government, okay, in terms of parliament, they pass certain rules and laws, and we need to abide by them. We need to follow them correctly. And SARS is then they're required to do the administrations. They apply the rules and they collect the taxes. So when looking at what system do companies need to follow, well, there's a few. Right, one of the systems, okay, in terms of compliance would be tax. They need to follow those rules. Right, other systems can maybe be in terms of operations, okay, in terms of the law. Maybe it could be reporting, so from an accounting point of view, in terms of the Companies Act or IFRS, whatever it is. The point here is, what systems or what system do companies need to follow? Well, if I'm focusing specifically on tax, I'm going to be using the Income Tax Act. I'm going to be guided by the rules in the Income Tax Act, as well as any SARS practice notes that may have been released by SARS. Right, so are these systems the same? Well, again, depending on what type of business you're running. If you're running a sole proprietor, you don't have a separate legal entity. Whereas if you're running a company, there is a separate legal entity. And that can also benefit the company, or the business, I should say, in certain situations. So the systems can differ slightly depending on your classification. Remember, taxpayers need to present their financials to SARS, and they need to obviously account for what has happened during the year. So there are different systems that could be implemented. Are there any differences in the systems? Well, for a SARS and a tax point of view, well, from a SARS tax point of view versus accounting, there could be certain discrepancies, and that obviously gives rise to more detailed tax workings or calculations where there's like a timing difference. And I'm not too sure how much tax you're going to be studying going forward, but in this module it's a bit beyond the scope. We don't cover deferred tax in any detail here, but it's just something to consider when looking at two different systems. You've got an accounting system and you've got a tax system. Right, differences between systems can arise because of these adjustments. Right, we know that in accounting there could be an adjustment for maybe income received in advance, or a prepaid expense, or an accrued expense even. Or maybe accountants have provided for depreciation. So now, does tax also provide for the same deductions or expenses as such? And that becomes the discrepancy. So we're looking at this whole difference between systems. We're looking at, well, if SARS as an entity is going to be accounting for tax, and then you've got the business in terms of IFRS and accounting for the business operations, right? Do we land up with the same profit basically, right? Because remember, SARS is not going to deduct everything that you have in line with what you've done in your accounting records. So accounting is separate to tax, right? They use a completely different set of rules. Accountants use IFRS, SARS uses the Income Tax Act. So those are just two different systems that we need to distinguish here. Right, so we're always going to be looking at legislation. We're always going to be referring to the rules that SARS has outlined in terms of what government has presented in terms of the budget, as well as different rules and laws of the country. Right, so I've just given you the slide just to highlight the main point. Right, in study unit 5, we're going to be focusing on the trading deductions and trading stock. That's what we're covering in this chapter. If you're looking at scope, okay, so where are we basically? We're looking at line number 2 in the format, okay, which I've highlighted on the slide. You can clearly see that we're looking at the less deductions and allowances. We're not looking at the allowances, we're looking at the deductions, right? Things that we can subtract, okay, minus from our income. Okay, remember, income will include everything that meets the gross income definition. It will also include specific inclusions, and it will take out any exemptions, right? That gives you your income. Right, in this chapter, we're looking specifically at the deductions. So in other words, what can I now subtract after I've got my income? What can I subtract from my accounting records? Later on, we'll look at a taxable gain, and then we'll look at the actual calculation for income tax. Right, so why do taxpayers want deductions? Well, the obvious answer is if I have more deductions here, I'm going to have less taxable income. If I can subtract more here, I'm going to end up paying less there. Right, so that's the big advantage. Taxpayers want to reduce their taxable income as much as possible, obviously in line with the rules and laws of the country. So how do we do that? Well, we need to follow the general deduction formula, and this is a very simple process, I should say, in terms of your analysis. So again, very similar to last week, when you have gross income. If I have gross income, I need to follow those 5 bullet points. Right? I need to address each topic separately. Right? When you look at the general deduction formula, we're looking at things that we can subtract. In other words, deductions. Right? So deductions would relate to those expenses that the business would incur during the course of business, during the year of assessment. So if I'm focusing specifically on the general deduction formula, well, here I'm looking at expenses that have been incurred during the financial year that I can specifically subtract or deduct from my income to get my taxable income as part of the format, okay, that we saw previously on the first slide, okay, or the slide just before this. Right, so just remember, the general deduction formula has 5 components. Each component is equally important, but in order for you to meet the general deduction, you need to make sure that all of these 5 bullet points have been ticked, okay, have been correctly identified. Okay, so I can only deduct an expense if all 5 bullet points have been met. So the first one is actually incurred, right? And on the slide, I've also included some of these cases, right? Just so that you can actually remember some of these as part of your study notes. Okay, you can go back to your study guide and you can look at this in more detail. The study guide gives you a few example activities, and they also give you a few notes there regarding the specific cases. But also refer to the textbook as well for additional information that can also help you. So when focusing on this whole idea of actually incurred, the word actually incurred, actual means it actually happened. It actually took place. In other words, it happened. It was performed. Okay, it was done, basically. So if I'm looking at this concept of actually incurred, right, the case that deals with this particular discussion point is the Edgar Stores case, and this is where they basically disputed this whole idea of when is something actually considered actually incurred. Okay, when do we have something that's an accrual in terms of the basis of accounting, and have I actually earned or incurred something in terms of the accounting treatment? So that's the first thing we need to establish. Right, has the business actually incurred an expense? Well, let's think about this. Let's assume we have water and lights. Right, are water and lights actually incurred? Well, as long as you're switching on the lights and you're opening up the taps, you are incurring an expense. So have I actually incurred it? Well, obviously, so it would definitely meet that definition. Right, the next part of the definition is looking at this: during the year of assessment. So again, let's follow on and let's still look at this water and light scenario. If I've used water and lights, obviously I need to look at, well, when did I use the water and lights? If I've used the water and lights during the year of assessment and I've been assessed in terms of the amount of water and lights that I've used, I can then include that as a potential deduction. So is it during the year of assessment or not? If it's not during the year of assessment, then you can't look at it. It has to be during. Okay, that's very important. Point number one, during the year of assessment. Not before the year of assessment, not after the assessment year. It's during the year of assessment. Again, case-wise, you can look at different scenarios where you have anything relating to time, okay, in terms of individuals, okay, the financial year from the start to the end, right? If it's a company, when did the company start its year? When did the company end its year? Anything during the course of that year would be considered as a potential deduction, so long as the rest of the points are met. Next point, in the production of income. If something is in the production of income, that means that water and light that I've utilized, right, have I actually utilized that within the business? So in other words, has that gone towards the production of income? Am I using that specifically in the business in order to run the business, in order to maintain the business, in order to operate, basically? So again, you need to focus specifically on different situations, and you might want to look at cases. So for this one, is it actually in the process of generating income? Well, in terms of sales and services, was this actually part of your production? So in other words, when looking at case laws, the PE electric tramway case talked about this whole inevitable concomitant or closely connected test, right? So basically what they had to establish in that case was, is there an inevitable concomitant? So in other words, if I am a manufacturer and let's say I'm baking bread or I'm baking cake, whatever it is, right? I'm cooking, okay? I'm running a restaurant. If you're running a restaurant, obviously water and lights, okay, water and electricity would definitely be part of the production of income. Okay, there's no way you can use the stoves or the ovens without having electricity. And if you're in a restaurant, same thing with water. I need water to either do the cooking or baking or cleaning or whatever it is. It's definitely an inevitable concomitant. So inevitable meaning, is it directly linked to that form of operation or that type of business? Right, so in other words, what type of business are you running? And depending on what type of business you're running, how closely related are these expenses to your operations, okay, in terms of your process for generating income. is then inevitable concomitant. So for example, if I was a printing company, I obviously need a printer to print, and that printer needs ink and paper. So the ink and paper that I'm using would be seen as part of that whole operations cost, and the stationery in terms of its cost would be considered as part of production. So the general deduction formula could then apply in that situation, okay, to the stationery that I'm using within the company. Right, so inevitable concomitant is something that you could remember in terms of the PE electric tramway case. Right, something else that came out of the case was this whole idea of closely connected. Right, so in other words, closely connected. The printer ink and the printer paper would obviously be closely connected, right, to the process of generating income. Right, so that's something just to consider. Remember, these things always are disputed. Sometimes a business might want to claim certain deductions, and SAR says no, they can't. That doesn't mean those things don't ever get addressed. Some of those cases get taken to court, and there's a judgment, and that's why we have all these cases that can help us in terms of our application of the rule of law. Right, so remember, everything needs to be based on the law of precedent. If I've got cases that I can use to motivate why, or basically why I'm going to deduct, or why I'm going to include a deduction, it's important to note that we need to follow those rules of those cases. Okay, what established, right, the production of income, and what is closely connected, right, or what is an inevitable concomitant. The final two bullet points here relating to the general deduction formula, again, very similar to the gross income definition. Right, the gross income definition, if you recall what it was, okay, we recapped it earlier today. We said one of the key categories was not of a capital nature. Right, so if I'm looking at the general deduction formula, if I want to claim expenditure, okay, and losses, right, in terms of a deduction, right, I cannot claim expenditure and losses that are seen to be capital in nature. Right, so very similar to what we had last week in terms of income. Okay, what is gross income and what is a capital gain? The same thing you'll have here in terms of the general deduction. Right, were those expenditure line items or losses attributable to an item that was capital in nature or not? Right, so for example, if I'm buying a second printer, okay, buying a second printer would be seen as being capital in nature, and it would therefore not be part of the general deduction formula, even though that expenditure, okay, that capital expenditure relates to this. It is capital in nature, and it cannot be included in this particular scenario, okay, under the general deduction formula. But let's assume I've had to pay for repairs to the printer, right, or I've had to pay for paper and ink for the printer. Right, then you have something that is seen as not of a capital nature. Right, repairing the printer wouldn't be considered capital in nature. Right, I'm maintaining it, I'm servicing the printer, I'm repairing it, I'm fixing it. Right, and same thing with water and electricity, or printer ink and paper. Right, it's not capital in nature. Right, and therefore those expenditure line items or those losses can then be included as a deduction. And the last point, just before we look at the last point, just in terms of cases here, I've got another case for you to consider, the new state areas case, and that's focusing specifically on expenses not of a capital nature. Right, so in other words, what am I going to include as deductions under the general deduction formula? Only expenditure and loss items that are not of a capital nature. And that's looking at that whole tree and fruit principle again, basically, if you consider similarities between gross income and then this one, which is items not of a capital nature. Just another note when looking at this particular topic, okay, when items are considered not of a capital nature, the biggest consideration always is, are you adding to the structure of the business, or is this part of the operations? Right, so the biggest distinction you can make here is there an enduring benefit? If there's an enduring benefit, those expenditure items or losses would be seen as being capital in nature, and it would therefore not be considered part of the general deduction formula. Okay, this is looking at deductions. All right, general deductions. And then finally, the last bit to consider were those expense line items, okay, laid out or expended for the purposes of trade. So in other words, did I buy those items for my business, okay, the purposes of trade, or did I buy those items for recreation, okay, for personal use? That wouldn't be applicable. Okay, so expenses in terms of losses and other charges that you've paid for, basically, has it been laid out or expended for the purposes of a trade? Okay, so in other words, am I conducting a business? Am I buying something that's going to be used for the business? Again, you can look at trading activities and you can reference the Burgess case. Right, what determines whether this is actually part of the company's operations, okay, or trade, right? Is it for the purposes of a trade or not? That's something to consider. All right, so always remember that there could be certain situations where you don't meet the general deduction formula, and if you don't meet all 5 criteria points, you cannot deduct that particular expense or loss. You have to meet the definition of the general deduction formula. You have to meet all those different criteria points before you can actually classify something as being deductible. Okay, so the most important thing to consider, if an expense is not deductible according to the general deduction formula, can it still be deducted? Well, remember, you have things that are generally deductible, and then you've got the general deduction formula, right? And those would all be things that are business related primarily, right? So if I have other expenses that are not deductible, right, can there be a special deduction? Well, yes, there can be. Right, here are some of the special deductions. Okay, but before we get there, maybe just to look at this, do any specific requirements need to be met for deductions to be allowed? And the answer is always yes. Okay, remember, there could be very unique situations that may apply, and in those unique situations, you are going to deduct based on specific requirements. Okay, and those requirements are outlined very well in the textbook as well as the study guide, which you can make use of. Right, so the first bit we need to look at here, okay, legal expenses. All right, again, specific deductions, okay, and they're special. They're special because these don't meet the general deduction formula, right? Because a legal expense would be seen more as capital in nature, rather than in the production of income or trade, right? So legal expenses, those are things that you would incur as part of running your business, but to protect the business as such. Okay, not in terms of general operations, right? So it could fall short in terms of the definition for the general deduction. So if it isn't a general deduction, well, does that mean I cannot claim all my legal expenses? Well, according to the legislation, SARS will provide you with a specific deduction, meaning you may still be able to include the legal expenses as a deduction to further reduce your income, okay, when working out taxable income. Right, same thing applies to restraint of trade. Right, just with the restraint of trade, you do need to look at the duration. So SARS will only allow you to provide for a deduction based on the number of years, okay, that this restraint of trade will apply to. It'll either apply for a specific given period of time or 3 years, okay, in terms of the duration. So it must be the smaller of the given time or 3 years. So if there's a 1 year restraint of trade, and let's say the business has made that payment, so they've basically paid someone, okay, they've paid an employee, but in terms of this restraint of trade, and that employee for 1 year or 3 years will not be allowed to trade in that same industry, right? So we're looking at the deductibility of that expense, okay, the restraint of trade, the cost that's incurred to restrain someone from trading, is then considered as a specific deduction, so long as it meets the criteria and so long as you are looking at the smaller time frame. Okay, and obviously you're going to apportion this depending on the time. Something else to consider: registration and acquisition of patents, copyrights, designs, and trademarks. Right, these are very specific and these are covered well in the textbook. So I will refer to the textbook later, so just bear with me. Right now I'm just summarizing all the possible specific deductions that can arise in this particular topic. Okay, deductions, allowances. Right, so basically just to summarize, if the patent, copyright, design, okay, the trademark, if the amount is less than 5,000, then it's generally the full deduction, so you're able to claim that. Right, if it's more than 5,000, then you need to apportion it, right, which is something that you need to consider. Okay, recent development, also something that's covered here as a specific deduction. Bad debts and credit losses. You can also provide for a provision, but that provision is limited to 25%. Okay, so you cannot provide for more of a special deduction unless you have a bad debt or credit loss that you've actually written off. If there's a provision for bad debt or a provision for credit loss, then the provision would be limited to 25%. Employer contributions to employee pension or provident fund, there's a 10% contribution limit there. The practice note that SARS has produced, can suggest slightly different percentages. So with this one, employee contributions, you can research it further if you choose to. Right, donations to a public benefit organization or a non-profit or NGO, non-government organization, a 10% limit applies there. With annuities to former employees, also something to consider. That could be a specific deduction, so paying something to an employee, a former employee rather, I should say, over a period of time. Right, would that be considered as, inverted commas, a general deduction expense? No. But could it be a specific? Yes. Okay. And then the last bit, a prepaid expense. Right, again, with a prepaid expense, depending on how much the actual expense is that you've prepaid, right, is this going to happen within the next 6 months, or is the amount less than 100,000? If so, then you'd be able to make use of that deduction. Right, just the notes regarding deductions. There are certain situations where you can have a prohibited deduction. Prohibited means things that you are not allowed to deduct. Even though these deductions specifically meet the general deduction formula, SARS says, well, or the rules I should say, says that SARS will not allow you to claim deductions for these particular items. And these are things relating to domestic or private expenditure, unlawful activities. Okay, so maybe let's say you're making a delivery as a company, as a business, and the driver of the delivery vehicle obtains a fine. Right, you cannot claim the fine as a deduction because you could maybe state, well, the driver was driving to a client to deliver products or services. You cannot claim that as a deduction. It's seen as unlawful. All right, so a fine or a bribe or anything unlawful would not be considered a deduction. Right, the company would still have to incur the expense. Okay, so notice I'm using the word incur, meaning from an accounting perspective, they would have to capture it. But from a tax point of view, they wouldn't. Right, a tax return, okay, regarding the income and expenses of the company, they will not include this expense, okay, for fines as part of the general deduction. And then you could have some other scenarios that don't specifically meet the general deduction formula, which are considered prohibited. Prohibited meaning not allowed. Right, there's a few here: insured losses, penalties, taxes, provisions, expenses relating to exempt income, and there's a few others that you can have a look at. Okay, I've given the specific section numbers from the SARS income tax legislation, but as long as you know what these deductions are and whether they are or aren't deductible, that would be the most important thing to consider when answering questions relating to this in different tests and exams. Okay, just a note there, other prohibited deductions include income carried to reserve fund or capitalized anyway, money is not expended for the purpose of trade, and obviously taxes, duties, levies, interests. Okay, there's a little note here just regarding the last part, which is the trading stock. But remember, businesses are going to incur expenses here in terms of buying and then selling stock. So if I'm buying stock, there are two different systems to take note of. Okay, this is from accounting. You've got perpetual and you've got periodic. So what I've used here just to highlight this is the cost of sale formula, which actually gets used in the periodic system. Right, so if you're looking at trading stocks specifically, in terms of opening stock, well, this is how you remember it. Right, what does opening stock do to cost of sales? Well, opening stock would increase the cost of sales. What is cost of sales? It's an expense. Right, so in terms of opening stock, because opening stock is going to add to your cost of sale, which is an expense, it's going to increase it. Remember, expenses are seen as deductions. Right, so opening stock can be deducted, right, from a tax point of view. Okay, you can subtract it. Right, closing stock on the other hand is different. Right, here you've got minus closing stock. So if it's minus closing stock, that means you're making the expenses less. Right, if you've got less expenses, okay, you'll have more profit, okay, more income. So basically, if we're looking at the deductibility of opening stock, right, because it's opening stock will increase the cost of sales, you would be able to deduct it. So you would subtract the opening stock. But with closing stock, you'd have to add it back. Okay, because think about it, the more closing stock that you have, if you subtract, okay, a bigger amount of closing stock, right, subtracting more closing stock, in other words, right, will land up with less cost of sales. Right, so you're going to have to add that back to your working. Right, then just a note regarding the historical cost of inventory. Okay, when purchasing inventory, any costs associated with acquiring the stock. So in other words, buying the stock. If I'm paying for transportation, if I'm importing the stock, if there's any insurance specific costs for that purchase, handling costs, rebates, etc. All of these things would be considered as part of the cost of inventory. Right, just remember when looking at the opening and closing stock, you'll see if you've gone to the textbook material and the study guide, they always look at the lower of cost and net realizable value, okay, or market value, just a separate word for it. So basically you're going to be measuring, okay, those inventory line items at the lower of cost and net realizable value, right, just to make sure that amounts aren't overstated and they're accurately stated as much as possible. Okay, so just to go through some notes here from study unit 5, if I scroll further down here, you'll see in terms of structure, you can clearly see where I am here in terms of the taxable income calculation. Right, before I get taxable income, I need to work out the income, which is last week's notes, okay, study unit 4, and then I need to take study unit 5 into consideration, which is the deductions part of it. Okay, with deductions you get 3 different types: general, specific, and prohibited. Right, allowances are covered in a separate chapter. Right, so this study unit, as you can see what UNISA has done there, they've highlighted that as being the focus. Right, background, we've looked at that, we've spoken about this. The general deduction formula, please go through all the bullet points. Right, you have to describe each and every single point in terms of the general deduction principle before something can be deducted. Okay, even here you can see in terms of the trade. Okay, we spoke about this. Right, is it in production of, not production, is it part of the trade of the business? So in other words, right, is it for the purposes of a trade, basically? So in other words, when looking at Burgess versus CIR, okay, the Commission of Inland Revenue, if I'm focusing specifically on Burgess, the principle here was to be able to claim an amount under Section 11A is just the section where the general deduction formula is discussed in the Income Tax Act. That's all it is. So when you see Section 11A, it just refers to that general deduction formula. Right? It is necessary for a taxpayer to be carrying on a trade. Okay, we know that. You've got that in your notes. Right? The fact that there is no continuity or that there is a lack of profit motive or risk does not necessarily mean that trading is not taking place. Right, so it doesn't matter whether you're making a profit or not. You just have to be considered trading. In other words, running a business, operating basically. Right, so as long as you're operating, whether you're profitable or not, that's irrelevant. Right, you are going to be able to claim a particular deduction according to the Section 11A general deduction formula if you can prove that this particular expense, the amount, was for the purposes of carrying on a trade. Okay, not looking at the profitability of a trade. Right, tax versus accounting we spoke about, expenditure and losses we spoke about, actually incurred, again, part of the definition for part of the definition, the general deduction. Okay, so just remember that when focusing on actually incurred, has this actually taken place? In other words, is this expense deductible? All right, so we need to establish with this concept of actually incurred as part of the general deduction formula. Right, so actually incurred meaning, if you look at this Edgar's store, you'll see before an expense can be deducted in terms of the general deduction formula, it must be unconditional. Okay, unconditional meaning it has actually incurred. It can't be contingent, meaning something has to happen before it takes place. But unconditional, meaning it has actually incurred and it will be paid over basically, or incurred, okay, in terms of an expense. Right, so this is kind of like an accounting consideration in terms of when something is incurred. It can't be contingent. Contingent meaning it hasn't actually incurred. Right? The incurring of the expense is contingent on a particular event, and that's something to consider, right, when looking at this Edgar's case. Right, we're looking at, has this actually incurred? That's what you can use when you look at theory questions. During the year of assessment, very simple. During the year, okay, so in other words, individual or business. Production of income, we also spoke about this. There's that PE electric tramway case, looking at in the production of income. Okay, inevitable, concomitant, closely connected. Right, we spoke about this. Right, not of a capital nature, also something that we need to look at. Right, if it is capital in nature, well then you're going to look at a separate chapter. Okay, you'll look at this chapter. Capital expenditure will have an allowance, potentially. Right, and that's something that we'll look at in the next study unit, okay, study unit 6. Specific deductions, okay, these are deductions that don't meet the general deduction formula but can be specifically deducted based on the legislation. Legal expenses are deductible. Just refer to the study section in the textbook. You'll see when legal expenses are paid in terms of the business's operations, okay, you would be able to claim a portion of the actual expenses. Right, here's an example. Were you able to work out how you arrived at 1,000 here? Right, if you go to the working, you'll see, if you go look at the actual information, it talks about the legal fees, okay, having been incurred, amounting to 6,000. Right, the compensation that was received was 60,000. Right, 10,000 was received relating to lost revenue over the total 60,000 represents a 6. Right, so see, I'm looking at this whole idea of the legal expenses and how does it relate to the business. Right, so if the compensation was 60,000 and you received 10,000 in terms of the lost revenue, well, a 6 of it would therefore be deductible. All right, so you're not able to deduct the full legal fees, okay, because you incurred 6,000. You'd only be able to claim, okay, a portion of it as a deduction. Okay, so it's basically the deductible portion. Okay, not of a capital in nature, obviously. Okay, with restraint of trades, okay, we spoke about it. Remember, there's this whole consideration in terms of time frame. Okay, so the shorter period, right, in terms of what the restraint was signed for, okay, and 3 years, whichever is shorter. So if the restraint of trade was signed for 5 years, you'd obviously use the small amount, so 3 years. Right, so remember, it is not the lesser of the number of years of restraint of trade, it's the lesser amount incurred after dividing. Okay, so just remember that. All right, lesser amount, not lesser period. So it's the, when I say smaller amount in terms of the year, okay, and the years that was incurred. So for example, 3 years, okay, versus 5 years. Obviously the lesser amount, okay, the smaller amount would be the 5 years, okay, because the 5 years would have a small amount because that restraint of trade would be divided by 5 instead of divided by 3. Here's an example. Okay, Mr. or Mrs. Y restraint of trade deduction is over 3 years. Okay, 3 million divided by 3 years gives 1 million, which is less than the 3 million divided by 2.5. Okay, which gives 1.2. Okay, so which one is smaller? Right, the 1 million. You must show both amounts of your calculation to get the working, okay, not wording, working, right, lesser of, okay, we spoke about that, the small amount, okay, the lesser of. Great, we've got registration, acquisition of patents, copyrights, designs, and trademarks. Again, there's specific legislation here, section 11GB and 11GC. This relates to the acquisition of patents, copyrights, designs, and trademarks. If you look at this table, this summarizes it very well. Okay, so if I'm looking at acquisition of patents, copyrights, and designs, if the expenditure is less than 5,000, okay, the allowance will be, right, what will the allowance be? The full amount. Okay, we saw this in the notes. Right, if the expenditure is greater than 5,000, then the allowance will be, right, 5% or 10%, depending on what you're looking at. Okay, you're going to have to go back to the notes. Let me go back to the notes quickly and just show you that. Here, 5% for the copyright, 10% for the design. Okay, with research and development expenditure, again, there can be a portion there that will be deductible, depending on whether it relates to the actual financial year. Okay, so it still needs to be applicable in terms of the year and what actually has taken place. If you look at the scenario, you'll see here, you had research and development expenditure, right, commencing on a certain date. Right, the cost was obviously 360,000. Right, Alpha Limited incurred further costs of 96 on the 16th of July. Right, then you've obviously applied for approval. Okay, remember you need to get approval in terms of this research and development from the Minister of the Department of Science and Technology. Right, so if that does apply, right, and those costs are eligible for deduction, then you'd be able to deduct it. So here they said calculate the research and development deduction. Well, if you're looking at what did they actually pay, they paid 360,000 plus the further costs, so there's the total. Right, that's how much they've paid. Right, now we need to know, okay, how much is deductible. Okay, deductible, in other words, how much can I subtract? Right, so if I'm looking at the 450,000, okay, if I go and look at the information, right, we can clearly see here that the cost of 360,000, okay, and then there was a further cost. But look at the further costs. The further costs were incurred on the 16th of July. Okay, here the approval was received by the Minister of the Department of Science and Technology on the 1st of May. So if you look at the dates, okay, 1st April, 1st May, 16 July. Right, so obviously May is the important date. And then you've got April here, and then you've got July there. Right, so this is when the approval was reached. Right, so the approval was reached when? On the 1st of May. Okay, that was when the approval for the project was received. Okay, so you can see they've given you a note here. Okay, 50% additional allowance, right, on 360,000. Note number 1, have a look. Research and development costs incurred before the date of receipt of the application by the Department of Science and Technology for approval. Right, so you do not qualify, okay, for the deduction. It's not applicable. Right, therefore Alpha cannot claim for additional allowance on the 360,000 as this was incurred before the date. Okay, that's obvious, right? So you need to have the approval. You can't just claim any research and development as research and development. Right, and then the 96,000, okay, 50% of the 96 as a deduction. Next, bad debts. Okay, we've spoken about bad debts. We looked at the doubtful debts, the 25%, that's fine. Okay, this relates to employer contributions. Public donations, we spoke about that, 10%. And that's about it. Annuities we also looked at, and prohibited deductions. I think that was it. Oh, the last bit, prepaid expenses. Right, here's the notes. Okay, if the prepaid amount relates to a period of less than 6 months, okay, or the aggregate amount is less than 100,000, right, you can then claim the full amount as a deduction. Trading stock we spoke about, opening stock, closing stock. Okay, opening stock here, deducted. Okay, closing stock, tax in the hand, so in other words added. So you'd add to the closing stock and you'd subtract or minus, okay, the opening stock. Okay, we looked at that, and that was it.